Hello, welcome to the Principia Podcast. I'm your host, James Ives. Today I'm joined by Leander. How are you, Leander?
Good, how are you?
Good. Today we'll be discussing stocks and the stock market. So, Leander, from my time knowing you over the semester, you've shared a lot about stocks. You run the investment club here on campus. What originally got you interested in the stock market and stocks?
About 4 years ago, I started to invest. I think it was a time, the first time I had a job, and I earned some money, and then I had a surplus of money because I didn't spend as much. So it was the first time in my life where I was like, all right, I have this money, what am I going to do with it? So I was looking for cars actually, and I almost bought a car, and then I was like, wait, if I buy this car, the money's gone, and the car will probably depreciate. So then I looked for other alternatives and found the stock market, and I read a few books about it. Yeah, and that's how I got started.
That's awesome.
The longer I'm invested, I start realizing that it's not as easy. Like putting money into a stock, sometimes the stock rises and you think, oh, I did a wonderful investment, and then it starts declining a lot and you start losing a lot of money and you're questioning your investment.
Yeah.
So that made me actually realize that I need to learn way more about this topic, because speculation won't bring you far.
If you were to summarize how the stock market works, how would you summarize it?
Well, the stock market is just a market. So if you took economics classes, you might know how a market works. It depends on demand and supply. Therefore, if there is a lot of demand, the price will go up and people will outbid each other. So yeah, essentially it's a market. It's good to understand that. But the market depends on future earnings of a company and the book value, but the book value isn't as important nowadays. So it's just about short term. Are you asking short term?
Short term?
Yeah.
Like
what the market depends on in the short term or in the long term.
I mean, long term you would want to have, some pretty good returns, but with how the stock market works, I'm wondering how can one smartly invest and get money fast?
Fast. That's not how the stock market works.
No.
Don't do that, because what you end up doing is you're starting to speculate because you're doing bets because you're trying to find the hottest stock in the market.
Yeah. Put
money into it, and that's extremely risky because the odds of winning money are way less than losing money.
So there's quite a great risk factor in the stock market.
There is. If you have no clue what you're doing, you probably end up losing money because you will be, just as I said, you will probably end up buying the stocks that everyone is talking about. You find them on the internet.
Yeah.
People will say, buy the stock, it already went up 1,000%. If a stock already went up 1,000%, it's extremely risky to invest.
Just talking about risk, one thing I read about is there is stock market manipulation. Happens a lot where big money investors that don't want a certain company stock to do as well as maybe theirs will invest, or they will try to manipulate how the market looks to give a false narrative that a stock is doing well when it isn't. And then people will go and invest in that because it's a hot topic. It's the hot stock that's out there. And then they end up losing a lot of money.
Okay. Do you have a specific
stock manipulation?
Do you have a specific example?
Well, one I know of is like The Wolf of Wall Street. Have you heard of The Wolf of Wall Street? I've seen that film.
I've seen it. Is it the one with DiCaprio?
Yeah, it is. Yeah.
Okay.
That one's a little bit different, but I've heard that there's a lot of stock manipulation within the stock market. I was wondering if you knew anything about that.
Well, I guess if there are lots of shares and if there's a lot of money involved, I think it's hard to manipulate a stock, because how a market works is usually the more players they are, the harder it is for a single person to manipulate it. But let's say it would be a very small company that would be worth 10 million on the stock market.
Yeah.
If someone would buy a lot of shares, like let's say shares worth for $1 million, of course the price would go up. So, but I think how stock how this manipulation usually happens is through information, because that's what moves the stock market. So
Yeah.
if like Elon Musk is twittering something, and let's say it's wrong, right?
It's basically false propaganda. So basically, big stock individuals, big players, will put out propaganda out there to get people to run to a certain stock or to run away from a stock.
Yeah.
And that's how they manipulate it.
Yeah. So there's a company called Hindenburg Research, and what they do is they short companies. So they bet on stocks, like losing. Let's say like the stock's worth going down, right? So
Yeah.
So what they do is they research companies that they think might be in trouble, and then they reveal something, put it out to the public, and usually the reaction is that the stock then plummets, and that's how they make money. So that would be stock. Stock.
Seems like a shady business.
Yes, that's very true.
Yeah.
But I mean, they themselves, they what they say is that it's good that they are revealing these shady things.
Yeah.
But the problem is that they're at the same time profiting
and it also depends on the accuracy of their betting, whether or not they're telling the truth or not.
Yeah. So often there are lots of lawyers involved after these researches.
Yeah. For someone who's new to investing, how would you recommend someone build their portfolio?
So, first of all, you shouldn't pick single stocks when you're new. When you're new to the stock market, you should always buy an ETF. So that's.
Can you tell us what an ETF is?
Yeah. So it stands for Exchange Traded Fund, and usually what it is, it's mirroring an index, like the S&P 500.
It's the car company.
No. It's an S, like the letter S.
Okay.
Then an and like A and
Oh,
B.
S and P, yeah.
A and P. S&P is Standard and Poor. It's just an abbreviation. And the 500 stands for the 500 biggest companies in the United States. So by buying a piece of an ETF, you are buying a piece of all these 500 companies at once.
Are there a lot of those out there?
Yes,
Yeah.
and not just for the S&P 500. They are for the Dow Jones or for and anything. There's even I think there are ETFs for renewable energy companies, and then they mirror like the biggest 30. But if you go for the S&P 500 ETF, you usually aren't wrong, because you're just profiting from just the general growth in the economy.
Yeah.
So you can't really be
very
wrong.
low risk.
It's
You're definitely going to get some returns.
Yeah, usually you get about 10% average return. But what you said about cars, I'm very sure there is an ETF for cars as well.
Yeah.
There are ETFs for everything. Why? Well, because when you buy an ETF, there is a company behind it, the company that trades these shares in this basket of shares. So they do charge you like 0.2% or whatever, which is a very, very small fraction, and it's worth it, because if you make 8% or 8 to 10 or even 12% per year with it, 0.2% isn't much. But if you buy a single share, let's say you would put all your money in one single share, that's extremely risky, because even if it would be a very...
Yeah, that's called falling in love with the share.
Yeah, that could happen. That's dangerous. That's dangerous, yes.
Can you tell us the difference, kind of define diversification versus falling in love with a share?
Well, they aren't opposites.
No?
It could, if you fall in love with a stock, you could end up just buying that single stock.
Yeah.
So you could, so I do understand what you mean. By diversification, you usually mean that you buy lots of shares. So let's say.
Yeah, it's like diversify.
Yeah. So
Get yourself out there.
for someone who's very, very familiar with the stock market and is able to evaluate companies, or to value companies.
Evaluate the risk factor, whether or not this stock is something that's good for you or not.
Let's call it this way. They would say diversification, meaning you are making your returns worse. That's just a funny way, diversification. Because by diversifying, you will end up with the average. But if you are so good that you should beat the average, you should not be diversifying.
You should stick to maybe one or two stocks.
I think Buffett has, most of his worth in Apple. I think about 50%.
Yeah.
And then I think 3 to 4 stocks that make up almost the other half. So he has maybe 4 or 5 very big investments. Because
he doesn't need to diversify as much because he goes above the
because he will beat the average. So
I would say most people don't.
Exactly, and that's why
it's probably important for most to diversify.
Exactly, and that's why when you start out, you should start with an ETF. Or I mean, you could randomly buy 30 shares or like 30 single stocks, right? That would also be a way of diversifying, but that would be more expensive because you would have to do a lot of transactions, right? So you might end up with spending a lot.
It gets a little bit more complicated then.
Yeah. It's just
But probably a good idea nonetheless. For like a beginner, what individual stocks would you recommend that you feel are very safe?
Well, that's hard to tell right now. A stock. What makes a stock safe? A stock is usually safer when the price is lower. So, but what makes an investment safe, besides the price, would be a competitive advantage. So companies like Apple, they have a huge competitive advantage because there's no other company like Apple. So if Apple isn't super expensive at the moment, and they still have this competitive advantage, which I think everyone can easily identify.
Yeah. Apple's also a company that does pretty well.
Yeah.
So you aren't going to expect something drastically terrible to happen, and then your stock that you bought just goes to crap,
So, so Apple, maybe Microsoft, Google, just, these companies that...
Big name companies.
Yeah, so why big name companies? Well, because they usually have some kind of competitive advantage, right?
Yeah.
I mean, if you invest in a startup, usually they don't have a competitive advantage yet. They have to prove themselves.
And there's more risk.
Yes, and of course you also have to look at their balance sheet, and you need to find out how well they're doing as a company. It's because if they have a lot of debt and they don't have much cash, the risk of defaulting is way higher. So there are lots of risk factors, and that's why it's important to learn more about the stock market, and that's what we're doing at the Investment Club.
What are some common mistakes you think people make when investing? Things that you would warn people against.
The biggest risk factor, I would say, are your emotions. That's the single most...
Emotions?
Yes, emotions. That will eventually... Even like you can pick the most wonderful company.
Yeah.
If it drops 10% and you will sell the share because it dropped 10% and you feel terrible about your investment, you will lose 10% of your investment. And I think no one in the world can buy a stock, and after you bought the stock, it will never ever go below the point that you bought it. That's almost impossible. Imagine you would buy the stock and it would never drop below what you. That's that's impossible. So if you can't handle having some percentage like minus sign besides you like next to your investment, then you shouldn't invest at all.
Mm-hmm.
So that's the thing. And then the second thing, that would be fear, right? The emotion of fear. Your stock is losing you money, and then you sell. And then there is greed, which is the opposite.
Do you think the stock market is driven by greed to some extent?
Greed and fear, yes.
Yeah,
of course.
Greed and fear.
That's why there are huge fluctuations, and that's why a smart investor will make money, because he will buy stocks when people are in fear, and he will sell stocks when people are greedy.
Yeah,
so
for sure. To get into some interesting topics involving the stock market, who do you think controls the stock market? Do you know who controls the stock market?
Well, just as I said, the market is a market, so there's no single identity.
No single entity?
No, it's not possible.
Okay. I read online that there's like the Federal Trade Commissions. They just oversee the fair usage of trading stocks and things. So I think there is still some type of control over the stock market to some extent.
Regulations.
Yeah, regulations, for sure.
Yes, of course there are. And it's good that there are regulations. It's like there are certain rules that, like when an insider is buying or selling stocks, they have to disclose that.
Mm-hmm.
These are rules that, like, because they want the stock market to be a fair and competitive place, like every market. So,
and there have been people that have abused that in the past.
There are always people always try to abuse things. Yeah,
that's fun to talk about, because like we mentioned like The Wolf of Wall Street. Have you seen that movie?
I have seen that movie. I don't remember him investing. I think he was more like a broker, right?
Yeah, he was a broker. He was a stockbroker.
Yeah.
He started off, just wanting to be a stockbroker with some big name broking company in Wall Street. But after the fall of, I think, 2008, the market crashed really bad, and he lost his job with that company. And then he picked up penny stocks, and he realized that he could lie and manipulate, trick people into thinking that penny stocks had more value than they actually did. And then from there, he was able to build his own company, his own stockbroking company, and it just got wildly out of control. Hence why it's the Wolf of Wall Street.
So he was lying about information about the stocks?
Yeah, he lied about information about the stocks. He would manipulate the market. When he became a big player on the market himself, he was able to manipulate people to think that his stock or his company for trading stocks had more value than others. And then people were like calling up his, stockbroking company a lot more and being scammed out of their money. And he was becoming wildly rich.
Yeah, well, I think whenever you give someone your money or you trust someone, you really have to trust that person. And so the beautiful thing nowadays, or let's say since a few years, is that you can have an online stockbroker, and you can buy and sell stocks completely independently from any stockbroker, like physical, like a person, right? You don't need a person anymore. You don't need
a broker to call up on the phone.
Because whenever you buy, let's say you buy a broker and you're like, hey, I want to, could you buy 100 shares of Apple for me? And his reaction would be like, oh, that would already manipulate you. Yeah. And then you would be like, what? Shouldn't I do that? And he was like, no, there's this other stock, like the small company, way better investment. And then you are manipulated.
I 100% think when it comes to your own money, you should do your own research and trust yourself, unless it's like family. And even then, it can be a difficult thing. When it comes to stockbrokers and like the huge issue that happened with the Wolf of Wall Street, do you think that's still an issue that happens on the market frequently, and there are stockbrokers out there trying to scam people?
Well, how a stockbroker usually makes money is by trades, because they usually get a commission. So I guess a stockbroker would try to make you trade a lot of stocks.
Yeah.
Right?
I'm not out here trying to make all stockbrokers look bad. There are
no.
plenty of like legitimate, great brokers out there.
Do you mean people that invest for you, or people that you invest like through? Like a stockbroker usually just you tell him buy the stock for me.
They invest for you.
Oh,
so
no,
they manage your portfolio probably for you, and they buy stocks for you, and that sort of thing.
So you mean more like a person, like a portfolio manager?
Probably,
kind of, right? Yeah. Or any, I mean, they are investment funds, and you can invest in those funds, and they will invest for you, or mutual funds.
Right.
So the reason why this can be a good thing is because usually those people are very familiar,
well educated.
Yes, exactly, and they
maybe
will
more than you. Yeah.
So the upside is you will potentially beat the market, and the downside is you have to pay these people for doing so.
Mm-hmm.
And so what I would look for is, like, how is the fee structured? Because, like, let's say there's no incentive for them to actually beat the market because they will get an annual percentage.
Yeah.
Right? Why should they beat the market if they get money anyways? If their fees are attached to how well they're doing, then they should rather do well. Right?
So that gives them some credibility, and maybe you can trust them a little bit more.
I think that's what Buffett did. He was like, I don't want a monthly fee or whatever.
Right.
I will just make money if you make money. And I think that's a way healthier relationship, because
that's a good relationship. Like, let's say you have a stockbroker. That's the kind of relationship you want to have with your stockbroker.
Yeah. So that would mean the stockbroker would only survive if he's doing well.
Mm-hmm.
That's it. So I think that would be that would be good.
I've talked to a few friends. I have a friend, and he told me that, through his experience with investing and working with stockbrokers, he doesn't like to talk to them as much anymore. He described them as garbage because, like, he would talk to them on the phone, and they really do enthusiastically try to sell you a certain stock, and they can be very greedy and not trustworthy. There are wolves out there, and you got to protect yourself, is what I've learned. But there are, I'm sure there are legitimate stockbrokers that you can trust.
Yeah,
it's hard to weed out.
I guess it's about relationship, about who recommended it, and just as I said, I think the fee structure is key. But
that gives them like some credibility.
Yes, and after all, you can always just invest in an ETF. And it's risk free if it's an ETF like the S&P 500. So if you buy an ETF that invests in, I don't know, startups, I guess that exists as well. That would be risky, of course. Yeah. So you have to.
What are some great names in the stock market that you've learned from, or that you look up to, admire?
Yeah. So Peter Lynch.
Peter Lynch?
I think he was a fund manager for Fidelity, and he beat the average lots of times.
Okay.
And then Warren Buffett and his mentor, Benjamin Graham, the author of The Intelligent Investor. So these are, like, I go for quality, not quantity. Like, right. If I think Warren Buffett is the best, then why should I listen to anyone else? Right. Yeah. So that's why I won't recommend you.
Well, that's why you diversify. I mean, Warren Buffett's great, but I think it's smart to spread yourself out a little bit more, with trusted sources.
Oh! You mean you'd rather have 10 people as sources for? I do understand what you mean. But me personally, I wouldn't. I would be very, very, very careful, like whom to listen to. Like there is a
maybe not 10 people. That's a lot.
There's a podcast that I'm regularly listening to. It's called Value Investing with Legends, and it's from the Columbia Business School.
Okay,
so
that's
it's a
cool.
Very renowned.
Is it run by students?
No, it's by a professor.
Oh, okay.
He does invite students sometimes. And they do have an investment club like us, and so this it inspired me to. Inspired
you to start the club?
Yes.
Yeah.
he invites very interesting people, and then I like to look them up, and I do like to listen to what they say. But because the thing is, nowadays, information, everyone can spread information, so I would be extremely careful in selecting. So I would just trust someone that has a very long and good track record. I would never listen to someone who never beat the market. That wouldn't make any sense.
Yeah, for sure. So are there any other big names that you're aware of? At the moment, I think I would have to look them up again. I'm not very good in remembering names. That's all right. With the club, and we're quite a ways into the semester now. How has it been going so far?
No, it's
very. What are some things that you guys been discussing?
Yeah, so we started off with with compound interest and.
Can you talk to us about compound interest? I think that's a key role. That's basically how you make money with stocks.
Yeah. So it's an exponential curve, meaning that in the beginning you won't make as much money, but the further along you go, the more money you will make.
Mm-hmm.
And the sad thing is that this discourages a lot of young people because, as you said before, like, how can I make money fast?
Yeah.
The stock market is not a place where you make money fast. It's a place where you make money extremely fast after a certain period of time. Mm-hmm. So you have to defer this.
Could you compare it to gambling? Like, is it possible, let's say someone decided to invest in an individual stock that was doing really well and they had slim chance, and then they just kind of hit the jackpot?
Yeah, I think it's perfectly fine to describe the stock market as a what do you say? Where's a place where you gamble? A casino.
A casino.
A casino, and
a casino for shares of companies.
Yeah, it's essentially it's all about risk and return. So it's the thing is, I think.
Do you think that would you encourage people to gamble a little bit?
No. Not at all. Oh, well, depends on how you define gambling. If you define gambling as the chance can be in your favor as well, then yes, I encourage everyone to gamble if the chance is 99-1 that you win.
If the chance, like, let's say it's like 60, maybe 80% chance that you'll win jackpot, would you recommend that stock?
On average, if you would win 80% on average, totally, that makes sense.
What if there's an extremely big loss, though? What if the risk value is like really high?
Well, if you win 80% on average, you mean compared to a total loss?
Yeah, that's what I'm talking about.
Well, then you just have to do it often enough. I mean, that's why you should never put. If you put 100% of your money into a stock and the possibility of winning is 80%, then the possibility of losing is 20%. So you can lose all your money. So you should not do that.
No.
But if you spread your money over 100 stocks and the average return is always 80%, like the winning chance always 80%, you will win 80 out of 20
You're
times.
guaranteed to win something back.
You would on average win 80 times out of 100 times, and I would totally do that. That sounds wonderful, right? So yeah, I once read I think it was part of a book, and there was some really smart guy who figured out a way how to win in the casino by counting cards or whatever, and he eventually got thrown out of the casino. So what he did, he went to the stock market, started to invest, because he said the stock market is the only casino that cannot throw you out if the odds are in your favor.
That's crazy.
Yeah. So I think.
What was his name?
I don't remember his name. I would have to look it up. But I think he wrote a book about this. And
do you know the name of the book?
I don't have it in my mind right now. I can tell you later. But okay. I wanted to read the book. But after all, it's hard to determine a specific win, like a winning chance when it comes to stocks. You can when you analyze a stock, you will understand if the odds are in your favor or not, but you can never ever come up with a certain percentage rate, right?
I feel like a lot of people want to make money fast. Would you say a smart way of doing that would be to diversify and invest more and more money over time into trusted stocks or ETFs. And kind of through that diversification, you make more money faster than you would if you were just investing in one ETF or one stock over a period of, let's say, 10 years.
Well, I guess it really depends on what your rate of return is. If you are able to beat the market, you will make money faster, right?
Mm-hmm.
So that's the thing. If you don't know much about the market, how should you ever beat the market?
Right.
When I'm saying the market, I actually just mean individual companies. It doesn't help you to know much about the market. What is the market? Like how you can't be familiar with thousands of businesses and know their worth. So when I'm saying know something about the market, is know how to value companies, individual companies.
Yeah.
And of course know know what external factors will how they will affect your company, like if the interest rate rises.
Mm-hmm.
Or falls, or other external factors. So you have to know some stuff about macroeconomics for sure.
Yeah. So you should recommend someone to probably read a book about macroeconomics.
Well, I would recommend everyone to there is a class here, Intro to Macroeconomics.
Mm-hmm.
I would recommend it to everyone. It's
your favorite class?
It's at the moment. I love all my classes actually.
Who teaches that class?
At the moment, it's Matthew Cox.
Shout out to Matthew Cox, Macroeconomics.
Yeah. Thanks, Matthew.
Yeah, absolutely.
It's just at the moment we're talking about the banking system, and I think it's so satisfying to finally understand how what happens with my money when I put it into the bank. Like why it's mind blowing. I think it's really great too.
Yeah. Banks are interesting because when you put money into a bank, or if you put money in savings, it can grow in savings, just like a stock. It
can, and we learned why.
Why is that?
It's because the bank lends out your money, and you will get a certain percentage of the return.
Who are they lending out your money to?
To borrowers.
Oh, okay.
Yeah. So.
Does that make you concerned, hearing that someone's lending out money that's in your savings?
Well, yeah, it's good to know. People should know about this, because people say, oh, it's no risk putting your money into a bank, but I think there are enough examples where banks went bankrupt and people never got their money back.
But the chances of that happening it depends on what bank you're with. So let's say someone who's with Chase Bank, chances are it's not going to happen because it's a huge company that services millions of Americans.
Usually the federal the Federal Reserve would bail them out, I guess.
Yeah.
So yes, no. It's good to understand it. I'm not saying that this would happen in America, at least not to a bigger bank. But there are enough countries where I wouldn't put my money into a bank.
Yeah, if you put your money in savings in a bank, the return that you'll get from saving and putting more in savings, it'll get more, but it's always going to be pretty small. That's the difference between that and the stock market, is you can actually get some pretty large returns from the stock market.
Of course.
Depending on how much you're putting in. But when it comes to a bank, it's not the same. It's always going to be pretty small.
Yeah, I mean, when you lend out money, you will have a fixed percentage that the borrower will pay you back.
Yeah.
When you buy a stock, the return isn't fixed. If the company is able to grow and multiply their earnings, the growth potential is not unlimited, but it's
phenomenal.
It's huge.
Spectacular.
Right. But of course, a company can go bankrupt.
Yeah.
And then you will never get your money back, and that's the risk, right? And that's why you have to analyze a company, because sometimes the risk of Apple going bankrupt tomorrow is probably 0.000 whatever percent. It's probably not going to happen. There will be people that will point out, no, I will never invest in the stock market because every company could go bankrupt tomorrow. That won't happen. If that's happening, it's going to be an apocalypse, I guess.
I mean, we've had situations. It's so rare, but there was the Great Fall of 2008. There was the Great Depression in the 20s.
Well, yes.
Not every company went down, but I would say all around, every company on the market suffered to some extent. Every company went down a bit.
That's
enough to make investors pretty upset.
In 2008, like, first of all, if you look at it, I think if you would have invested right before this crisis, I think you would still have at least doubled your money until now. I guess even tripled or quadrupled. If you would have bought in the crisis, you would have probably had tenfold returns. That would be the best thing that could have happened to you. Same in the COVID crisis. If you would have bought stocks when prices fell, you would have had multiples in returns.
Yeah.
So that's why that's this greed, fear and greed. When people are fearful, and it's not backed up by, like, if the company is doing well, if the company isn't doing well and people are selling, there might be a reason, right? But if people are just selling because some weird stuff going on somewhere on the planet, you shouldn't be.
Have you ever been to Wall Street?
Yes,
You have.
I've been in front of the New York Stock Exchange. Yes, of course. When I went to New York,
I want to talk about that because I've never been to it, but I've seen films and I see how it's portrayed. It's extremely chaotic. Tons of people running, trying to get their stock, trying to get the hottest stock. People throwing hands, people shuffling. It's a hot mess.
Well,
is that realistically what it's like?
I haven't been inside the building. You can't just enter the building. I just have been in front of it. And I think nowadays, most of it is just through computers.
Okay.
It doesn't really matter where you are.
Maybe that's what it was like.
Probably,
a long time ago.
Yeah, but I think there's usually there's the NASDAQ. I think that's just completely electronically.
Yeah.
So it's all automated. That's why
I think online. I mean, the stock market itself is rather chaotic. It's just we have it maybe in a less physical form now. Everything's digitalized and on computers.
Oh, you mean if you mean chaotic? If you mean that the fluctuations are high, they're probably higher now because they're just there's like information spreads faster.
Yeah, that's exactly what I'm talking about.
There are more people involved, and it's I guess it's even better for investors nowadays. There are other factors, but because information spreads faster now, everyone has the information available. Back in the days, like Buffett described, like that it was really hard to get information, so you could have an edge if you had more information than others. But nowadays, it's harder to have information that other people don't have.
Right. All right, Leander, I think that's going to conclude our session. Thank you for sharing all that you know about stocks. It was very interesting. Next week, we'll have more interesting topics.
All right. Thank you very much.
All right. Woo!
Oh, nice.
Good stuff.
Yeah.